I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on the tax implications of people who work in the U.S. but decide to retire abroad.
With rising healthcare and living costs, more and more U.S. citizens are retiring outside of the U.S. Add to them the number of international workers who contribute to retirement accounts while working in the U.S. before returning to their home country, and millions of people face potentially complicated international tax issues when taking distributions from their pensions, Social Security, and retirement accounts. In today's episodes, we discuss the unique tax considerations faced by people who once worked in the U.S. and who retire abroad. Hello, Lisa.
Hello, B.
What are we talking about today?
I'm excited to return to some international tax topics.
Okay.
You know, it's like my happy place.
It is your happy place, yes.
But I got to say, this stuff it's important, but it gets really complicated really fast.
It can, but I'm hopeful that today we can do a good job of breaking it down so everyone can understand.
I am hopeful as well. So first, let's clarify who we're talking about today. When we first started researching this episode, we thought we would cover this content and the content on the last episode where we talked about tax considerations for international students, many of whom stay in the U.S. at least for a little while, and we thought we could do it all in one episode.
We did. We were optimistic.
Yeah.
And we quickly discovered that it was way too much to talk about in one episode.
Yes.
So as a very quick recap, our last episode talked about different visas for international students and workers, when someone is considered a U.S. tax resident, and how U.S. income and payroll taxes work for them as non-resident aliens versus resident aliens. And spoiler alert we said it was a little bit harsher if you were a resident alien.
Yes. And once again, alien here in this context just means not a citizen or permanent resident. We're not talking about little green
No
men
little green
women.
men or women.
Yeah.
Or non-binary.
No.
Yes.
And we're still speaking to those international students on this episode.
Yes.
But as we thought about it more and more, many of the things we'll cover today when we're talking about taking distributions from retirement accounts like 401ks or individual retirement accounts, they also apply to U.S. citizens who decide to work or live or retire abroad. And thus, a second episode was born.
I love it. Taxes for more of the masses.
Me too.
All right, so today we're going to talk about retirement planning for those working for an employer in the U.S., but expecting to live outside the U.S. when they are retired, and maybe sooner.
Yep.
We're going to cover contributions to retirement accounts and distributions from those accounts. So both what happens when you put money in and when you get your money back out.
Yep. And for those of you who are not longtime listeners, let's do a quick recap of tax preference retirement accounts in the U.S.
And this really is your happy place because we're talking about retirement and international
I know.
stuff.
It's all the things.
Jeez. This is your CAMT R&D episode.
It is.
Okay. Tax preferred retirement accounts come in two flavors, traditional and Roth. Traditional plans give you a deduction when you contribute to the plan, so you are contributing pre-tax dollars.
Yep.
That must mean that when you take a distribution, you're going to pay ordinary income taxes on every dollar you withdraw. Mm-hmm. Roth plans are just the opposite. You don't get a deduction when you contribute, so you contribute after tax dollars. But when you take a distribution, you don't owe any taxes on the dollars you withdraw.
Exactly. So under both flavors, your interest, dividends, and capital gains earned while your dollars stay tucked safely away inside your account are not taxed. So the big benefit of these plans is that you get to compound your retirement earnings at a pre-tax rate of return.
Last point. There are two sources of these retirement plans. They can be set up for you by your employer so that you can make contributions directly from your paycheck. Mm-hmm. And these are plans like 401ks, 403bs, and thrift saving plans. Alternatively, you can set one up for yourself and contribute to it from your bank account. Those are individual retirement accounts or IRAs.
Okay, great. I think that's enough basics for now. So let's move on to contributing to these plans. All of these plans limit how much you can contribute to them in any given year because there are big tax benefits associated with these plans, and the government can afford to give away those unlimited.
Agreed. But generally, U.S. citizens and permanent residents can contribute up to those limits in any given year. Where it gets tricky is for those international students who are here studying under F1 visas. Maybe they're doing an internship during school, and maybe they're staying after they graduate to work under the optional training program or OPT.
Yeah. As we discussed in our last episode, F1 and OPT visa holders are generally non-resident aliens, meaning they're going to be taxed by the U.S. only on their U.S. income and not on any income that they earn back at home. For non-resident aliens, the opportunities to contribute to retirement plans like 401ks and IRAs are unfortunately limited.
That is correct. In fact, non-resident aliens generally cannot contribute to IRAs, anything at all. Zip, zero, zilch, nada. They might be able to contribute to an employer-sponsored plan like a 401k if the plan allows it.
Right.
But often, non-resident alien participation is explicitly excluded in the plan.
Yep. However, if or when they become resident aliens, they suddenly gain access to these retirement savings tools, including both 401k type plans and IRAs. And in both flavors, as long as they're offered by their employer, for example, traditional and Roth type plans.
But because many of these professionals plan to return home someday to a country outside of the U.S., we need to tackle the tricky part.
Yeah.
What happens when they leave the U.S. and decide to withdraw funds from their retirement accounts?
Yeah, and this is where we realize this question is a much bigger one than we originally thought.
Yes.
And that's because this is an important question, not just for our international students who may return home someday, but also for anyone working in the U.S., including U.S. citizens who may want to retire outside the U.S. someday.
Exactly. And for those U.S. citizens planning to retire abroad, they may also want to consider how their Social Security income would be taxed.
Yeah.
Hypothetically.
Hypothetically.
If that's still a thing by the time that they retire.
If it still exists, yes. So this is where planning pays off. There's two main considerations. The first one's pretty straightforward and has to do with early withdrawal penalties. So generally, anyone, whether a U.S. citizen, permanent resident, non-resident alien, on an F1 or OPT visa, resident alien, or you moved back to your home country years ago and haven't set foot in the U.S. since, anyone who withdraws from these regulated retirement accounts like 401ks and IRAs before the age of 59 and a half is going to trigger a 10% early withdrawal penalty paid to the U.S. government.
Exactly. And I think that makes sense,
Okay.
even though we're talking about a penalty.
Yeah.
And that's because the point of these accounts is to force you to save for retirement by
Yes.
giving you tax incentives, not forcing, but encouraging, strongly
Yeah.
encouraging you.
Yeah.
And they're going to give you tax incentives either for the money you contribute up front via a deduction if it's traditional plan, or tax exempt income if you withdraw money from a Roth. But the point is the government wants you to keep the money in your account until a reasonable retirement age, which they have deemed to be 59 and a half.
Why a half?
That's an excellent question.
I've never understood that.
That is an excellent.
Yeah.
Maybe the cognitive decline between 59 and 59 and a half is substantial.
Maybe. Okay. Moving on
Yes.
to the second consideration, which is more complicated, and that's income taxes.
Sorry, did you say more complicated?
I did.
I'm already feeling very overwhelmed.
Okay.
I think I need a break.
As you wish.
Oh.
Oh.
Okay.
Rest in peace, Rob Reiner.
It's been too long since we've had a Princess Bride reference, and I don't like it under the circumstances of the last year.
I know. Inconceivable.
I do love it though.
Yes. You're very smart. Now shut up.
Okay, so far we have recapped what retirement plans like 401ks and IRAs are. We've talked about how non-resident aliens are generally severely limited in their ability to contribute to these accounts. We've also talked about the fact that when it comes to withdrawing from these accounts, everyone needs to wait until they're at least 59 and a half, not 59, to avoid penalties. Now we're going to talk about the income tax on those withdrawals.
Okay. Here there are two questions. First, will the U.S. tax your distribution, as they would for U.S. citizens and permanent residents living in the U.S., when you withdraw from a traditional retirement plan? And second, what about the other country where you're living when you withdraw? Is it going to tax your withdrawal from these accounts?
I feel like that's tricky.
It's
because
tricky.
We just were talking about the U.S. and now you flipped it and you added
I know.
another country
I
in there
did.
too.
Yes.
Okay. Well, I want to tackle the U.S. question first.
Fair.
Because I think I have a better chance of getting that one right.
Okay.
The U.S. will never tax a withdrawal from a Roth account
Correct.
because they already taxed the earnings that you contributed to the account. Remember that with a Roth, you're contributing after tax dollars. So we're really just talking about traditional accounts when we're talking about U.S. taxation of withdrawals.
It's a great point. So let's tackle the U.S. taxation of withdrawals for U.S. citizens living abroad first.
Okay.
U.S. citizens are taxed by the U.S. on their worldwide income.
Yup.
So the U.S. is going to tax withdrawals from traditional flavored accounts as U.S. taxable income and tax at ordinary income tax rates, regardless of where you are living.
Agreed. Easy enough.
Okay.
Now let's consider if you're not a U.S. citizen, but you're a U.S. tax resident, like a resident alien.
Okay.
The situation we're thinking about here is that you've been working in the U.S., say on an H-1B visa, you've been contributing to these retirement accounts, and you're about to move back to your home country, so you decide to cash out before you leave.
Yep. And as we've already said, you're going to pay an early withdrawal penalty of 10% unless you're at least 59.5.
Plus, the U.S. will generally include the amount of your withdrawal from traditional accounts as U.S. taxable income and tax it at ordinary income tax rates. You may also owe state taxes if the state you live in has a personal income tax.
Okay. It gets a little more complicated if you're a non-resident alien. What we're talking about here is someone who lived and worked in the U.S., contributed to a retirement plan here, and then moved back to their home country. Now they're taking withdrawals from their U.S. retirement plan. And if it's a traditional flavored plan, the general rule is that the U.S. is going to tax the withdrawals at a flat 30% tax rate.
That feels high.
Mm-hmm.
Excessive.
It's high.
Now I'm going to say the sentence that I don't want to keep saying.
I know.
You may qualify for a reduced rate or an exemption under a treaty.
Your favorite.
So, for example, Chinese citizens may qualify for an exemption from U.S. tax on distributions from 401ks, but not from IRAs.
Mm-hmm.
And they have to file a form with the U.S. each year in order to claim the treaty benefit.
So straightforward.
Very easy. I like
Yeah.
it.
So remember, we've been talking about U.S. taxation of distributions from traditional 401ks and IRAs because the U.S. is not going to tax withdrawals from Roth accounts.
Correct.
Because that's how Roths work. Now, that may sound like there's a big benefit to contributing to Roth flavored accounts if you plan to retire abroad. But now
yes,
we need to talk about
yes.
how that other country is going to tax
Okay.
your distributions.
Okay.
Right?
Thought I was going to get to eat my cake and have it too.
Yeah. It's complicated because it can vary by country.
Are you going to tell me to go look up a treaty?
I might.
All right. So countries differ in their definitions of tax residency, but generally, if you're residing in another country, you're likely to be taxed on your income by that country.
Exactly. And that means that the country you're living in could potentially tax your distributions from U.S.-based 401ks and IRAs, regardless of whether they are traditional or Roth in flavor. And regardless of whether the U.S. is also taxing those distributions.
Okay. This seems like a lot of tax.
Yeah.
So let's try to break this down. Let's try to be logical about this.
Okay.
Let's start with traditional.
Yep.
We said the U.S. is usually going to tax those distributions because they didn't have the chance to do it before. Those are pre-tax dollars.
Yep.
And now you're telling me that the foreign country is also going to tax them?
Yes.
Okay. Don't like that answer.
And here's your favorite
Nope,
sentence.
not doing it.
You got to go look at the double tax treaty.
Don't want
to determine whether the treaty provides some relief from double taxation. In some cases, the treaty is going to say that you may qualify for an exemption if the funds are coming from a U.S. account or the U.S. government, like Social Security. This is the case with the U.S.-Mexico treaty. So as a U.S. citizen, you may be exempt from Mexican taxes on this type of income, but you'll want to run your specific facts by a tax advisor to be sure. Mexican citizens generally owe Mexican taxes on these distributions. So citizenship matters, type of account matters, all the things. Treaty matters.
So I would hope that at least
Yeah.
you could get a tax credit so that you don't get double taxed by the U.S. and Mexico, for example, on the same income.
And you would be right.
Okay.
In many cases, you can get a credit for U.S. taxes paid against your tax obligation in that foreign country that
Okay.
you're residing in. So, for example, Mexican citizens can get a credit for U.S. taxes paid against their Mexican tax obligation. So they're generally only going to owe the difference between the two because the Mexican rate is usually higher than the U.S. rate.
Interesting.
Yeah.
Okay. I like that. That was
Okay.
traditional.
Yeah.
Now let's talk about Roth.
Great.
Again, we said the U.S. won't tax those distributions because they went in as after-tax dollars. They've already been taxed when you contributed them.
Yep.
But now we're in a situation where the foreign country could tax those distributions or withdrawals.
Yes, it could. Again, you could qualify for an exemption under treaty. like possibly those U.S. citizens in Mexico. But generally, the foreign country is going to tax those distributions. And since you're not paying U.S. taxes, you won't have U.S. taxes to take as a credit against those foreign taxes.
Yep, got it.
All right. There's one last consideration, and here's where things get messy.
Right, because it was all super clean and easy up to this point.
Relatively speaking?
No.
Yeah?
No.
Okay. You remember how we said that your interest, dividends, and capital gains earned while your dollars are tucked safely away inside a retirement account are not taxed by the U.S.?
I do.
Okay. Well, the U.S. sees things that way, that those are not taxable income, but not every country agrees. So India, for example, generally does not recognize traditional or Roth IRAs as tax-advantaged accounts. They view them as ordinary foreign investment assets. So India could tax your interest, dividends, and capital gains while you're living in India before you're even withdrawing from these accounts.
But wait. India introduced a law in 2021 that allows Indian residents to defer Indian taxation on investment income in traditional foreign retirement accounts until the income is actually withdrawn.
Which makes traditional plans more advantageous than Roth plans in this specific scenario because the Roth often fails the condition for this deferral. But you still have to file a form with India each year to apply for this exemption on your traditional accounts.
Okie dokie. So Indian residents should probably stay away from Roth plans if they intend to return home before withdrawing all the funds, and they should file that form every year with India.
Agreed. And everyone else has to do some sleuthing of their specific double tax agreement between the U.S. and their country that they're going to go live in. Does that treaty give you an exemption? Does it give you a lower rate on those withdrawals? What about the foreign tax credit? All of these things you need to go to the treaty to figure out.
I mean, pay somebody to go to the treaty and figure it out for you.
Okay.
That's my advice.
Okay.
In addition to that, answering all of those questions that are going to be in the treaty, you probably also need to do some advanced planning and a little bit of math. If you're on an H-1B visa and you'd face high tax rates at home, whether on distributions or on your investment income earned in that account before you withdraw, in addition to potentially owing U.S. taxes, it might be worth paying the 10% early withdrawal penalty to the U.S. plus state taxes before moving home and avoiding foreign taxes altogether. It may be, but it may not.
Yeah. And for U.S. citizens, they're going to need to think pretty hard about whether they want to pay foreign taxes on their 401k and IRA distributions before deciding to retire overseas. And this was new to me in researching this episode because, you know, I do have some dreams at some points in time of like, you know, retiring to Portugal or something crazy like that. Yeah. And this gave me pause.
It's going to make it a whole lot more complicated of a decision than just, do I want to live someplace else?
Yes.
Yeah, I agree with that.
Yeah. What do you think? Would you want to retire overseas?
Not after this.
Okay. Time for the good, the bad, and the ugly. And I think the good is that this is an important topic for a lot of different people.
Yes.
So I'm glad that we've tackled it, even though it was a lot.
It is a lot. And I would say that we talk about some things that, like, I feel pretty confident if you listened to our episode and did a little bit of Googling, like, you could probably get to the right answer. I would not say that this is one of those situations.
It's extremely complex.
So if you are thinking, if you're in a situation where you either have to go back to a different country or you think you might be considering it, talk to somebody, and to your point, probably talk to them a little earlier rather than later.
Oh, totally.
So that if there is some planning that you can do to mitigate things, you give yourself enough runway to do that.
I mean, it's enough to make you wonder if you're not a U.S. citizen coming to work in the U.S. for a while, but you know you're going to go back home. Like, do you even contribute to these accounts?
Exactly.
Yeah.
Yes. Or just
is it even worth it?
Some other way in your home country and avoid the U.S. issues altogether.
Totally.
But yeah, I think good that we're scratching the surface on this. Do not attempt this at home is what I would say.
And also I've had a lot of students over the past year who have tried to use AI to help them figure this issue out.
No.
Yeah.
Nope.
The AI has not been batting a thousand on this, even close. So I would say the ugly part is that it's so complicated. Even our robot overlords cannot figure it out.
I think that that is a really good point that you brought up. And just to digress a little bit, like AI excels at many things, but unless you're using like a tax research specific AI tool, like if you're just into some free AI thing that is scouring the internet and also websites of shady people who are trying to sell you things, it doesn't differentiate between what's good advice and what's bad advice.
And it can just get things completely wrong.
Yes. I mean, I don't even know if I would trust it if I fed the treaty into it and said,
that's what I'm wondering. Yeah.
Because I've had it make mistakes. I had it in my accounting for income taxes class this year. I fed an actual accounting standard into one of the tools. I won't say which. And I asked it a specific question. It got it wrong.
Yikes.
So you really, really, really do have to verify the output. And I hope we've conveyed that there are a lot of tax dollars potentially at stake here. And you're not doing yourself any favors if you're going to the IRS trying to say, but the robots told me that I didn't owe any tax on this transaction.
I do not think that will be an acceptable defense.
It's not going over at all. So do not try this at home, and do not try it at home with the assistance of AI.
Yes.
So yes, bad, complicated, lots of moving parts. When we're giving you advice that it may be worth it to pay a penalty, you know that things have gotten weird.
Yeah.
And I mean, is it just fair enough to say the ugly is that AI did not get a whole lot right when we were researching this topic?
That was my ugly.
Okay. Yeah. I just think that how important this is, and to your point, how many people are facing situations like this, it should be easier to figure out.
You would hope it would be, but there's so many moving parts.
Yeah.
Yeah. Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.